California is the fifth or sixth largest economy in the world, and it's an incredibly important market for Citibank. LA County is a very, very important market for us. In terms of CRA needs, it's our second or third largest throughout the bank. Conversation about what a potential workforce housing transaction could look like. What are the sources and uses, and how do you get it built? The discount to market creates stability. Stability lets us kind of push underwriting criteria. Bryan Barker. I am a director at Citi Community Capital. I am based in San Francisco. Citi Community Capital is the affordable housing lending and investing arm of Citibank, developing relationships with both for-profit and nonprofit owners of affordable housing properties throughout the country. And Citi provides comprehensive capital solutions, both debt and equity, for developers and owners of affordable housing properties throughout the country. Citi is a global 200,000 plus person corporation. And we are the affordable housing lending and investing arm of Citi. We're the only part of the bank that can offer construction financing. So for Citi to offer construction financing, there has to be some affordable component to the transaction. We're a part of the ICG, which is the investment bank, and we're actually housed in the municipal securities group as well. Provides terrific synergies for our clients throughout the organization. Citi Community Capital is a group of about 160 to 170 professionals throughout the country. Last year we did about $7 billion of production from 150, $175 million construction loans for new properties in New York, all the way down to 50-unit ground-up new construction property in California. Average loan size is between $20 and $30 million. Some are as small as $2 million, and some are well north of $100 million. The $7 billion is all product, all rental, multifamily, residential. Nothing is for sale. So construction loans, perm loans, investment banking, or acquisition loans. If I had to guess, it's probably about $4 billion was construction. The golden rule to be eligible for CRAs, 51% of the units need to be income restricted at 80% of AMI. There's some things you can do around the periphery. It depends upon if the property's in an empowerment zone or an economic development zone, but that's a good general rule of thumb. California is the fifth or sixth largest economy in the world. California is far and away our largest market. I think we did a little over $2 billion in California last year. It's our largest market. It's our most important market. Citi's had a large presence in California and in the affordable housing space. Goes back, by 25 years to predecessor firms as well. California is just a crucially important market for us. Predominantly, our efforts are concentrated in Los Angeles County and the Bay Area, but we're active all the way up and down the coast from San Diego all the way up to Eureka. But LA County is a very, very important market for us. In terms of CRA needs, it's our second or third largest throughout the bank. We employ a number of people in LA, long been a provider of debt and equity for affordable properties, and hope to continue for a number of years. The whole discussion is about the missing middle, workforce housing. How do people that earn too much to be excluded from LIHTC properties, where do they live? People between 60 and 100% of AMI. And that's a huge number of Californians. It's police officers, it's firefighters, it's a lot of municipal workers. People are really struggling to find safe, clean, affordable housing. What a potential workforce housing transaction could look like. What are the sources and uses, and how do you get it built?
So we got 235 unit project that's 100% deed restricted to this sort of missing middle income segment. Total percentage of costs, you're underwriting on $104 million total budget. How big is the construction loan?
It's kind of a high level what sources and uses would look like. And again, rough numbers, it's about 2/3 debt, 1/3 equity. Construction loan is, round numbers, call it 70 million. So 70% of cost. And that 70-30 split between debt and equity, I would say that's pretty common. The debt, which is typically between 60 and 80% of development cost, that's relatively, I don't want to say easy to get, but it's, there's a market for getting construction and permanent debt on affordable properties. The challenge is the equity side. In this transaction, there is a need for, call it, $25 to $30 million of equity. And when rents are lower relative to market, you can't generate as high of a return. So what kind of equity investor are you going to entice to deploy capital into this transaction? Socially minded and patient equity. And this is this is where the challenge is, right? Where are you going to find the equity to create these numbers of units? And that's where the rub is. And, on workforce housing deals, we've been willing to go down to a 120 debt cover instead of a 125 or 130, and maybe looking at using something else other than a 30-year amortization, i.e. a 5-year amort. However, to do that, we need to be able to show that there is a meaningful discount to market rents. Our portfolio and our history has taught us that if there is a significant discount to market rents at our property, A, it'll attract tenants, and B, those tenants are willing to stay there, and it just creates a stable operating property. There's less turnover costs, there's less volatility, less vacancy, and the combination of all those things gives us the comfort to be able to push the underwriting criteria. Mm-hmm. And we're doing it in a risk-responsible manner. But historically, affordable properties have been incredibly consistent in terms of their cash flow, right? Cash flow is just a steady line as opposed to market rate deals. We saw this time and again during the pandemic. Market rate properties were 20-30% vacant, sometimes more. And affordable properties stayed full, and people paid rent because they know how valuable that unit of housing is. About earlier, in terms of why are we comfortable pushing some underwriting criteria? Snapshot of the unit mixes, studios, 1s, 2 bedrooms. One of the columns is market, and those are the estimated market rents. And then the column right to the left is the underwriter. Here we're showing call it a 26% discount to market. That's pretty meaningful, right? And to me, what that says is, people are going to be incented to move there, right? Because they're saving quite a bit of money compared to an option down the street. And they're probably going to want to stay there. Affordable properties are very consistent in terms of cash flow. And that's really what we look for. And that's really what we look at when evaluating transactions is why would people want to live here versus the alternative?
You're basically taking $2 million off the top line rental revenue.
The affordable property has $2 million less of NOI compared to a market rate property.
Yeah. So
what are you getting? You're getting a 120 debt coverage and potentially a 35-year amortization. I know this is set up to 30, but we'd probably go to a 35 here. You're getting more favorable underwriting criteria, which will generate excess debt. Whereas if this were a market rate deal, it'd be a 125 or 130 debt cover and a 30-year amortization. If you go to a 35-year amortization, it gets you about another $4 million in proceeds.
If you're looking at like a $70 million loan, you're looking at an extra $4 million of loan proceeds.
$4 million less to raise from an equity partner. A market rate deal would have a 125 debt cover, 30-year amortization. That takes the debt down to like 64 million, and affordable, you could probably get that up to like 73, 74 million. It's a dollar difference. The discount to market creates stability. Stability lets us kind of push underwriting criteria.
What's interesting with this last page is so you're not constrained by the costs, the loan to costs. You're constrained by the cash flow. From an LTV standpoint, yeah, you're willing to go 80%, 80 million on a $100 million deal, but you are constrained with the cash
you're
flow.
stopped out by debt cover. That's right. That's right. You used to be LTC constrained, loan to cost, but as costs have gone up, incomes haven't gone up as much. So yeah, now you're capped out by debt cover or cash flow. I mean, what we're starting to see is cities aren't giving you the choice. It's if you want to build, there needs to be an affordability requirement. And then you kind of get into a discussion of, okay, well, maybe we can trade affordability at this site to get unrestricted at this site, and this site takes on a little bit more affordability. We are seeing quite a bit of that happening. Finding socially minded, patient equity. I mean, the group that just kind of stands out are the CalPERS, the CalSTRS, the pension funds who, I do think that they are trying to figure out a way to be an active participant in this space.
Is there any such thing as like 100% moderate income deed restricted projects that you've seen? Right?
We're starting to see them now. Yeah, this is what's exciting. The conversation has turned from deed restricting units at 60% of AMI or below, i.e. bonds and tax credits, to moving that up to 80, 100, 120% of AMI. And that's a new development in the last 12 to 24 months. And it's the whole discussion around the missing middle in California. And it's kind of the next chapter of affordable housing in this state. There is appetite in the debt markets for this type of product. I would say it's kind of in its infancy, but we are seeing Freddie Mac be a meaningful player in this space. There's also a unique structure in California specifically where governmental entities own properties and there's a third-party operator. There are kind of two parts to this conversation. One is potentially giving banks more leeway to get CRA credit on transactions that historically haven't been eligible for CRA, and to the discussion about equity. And this is where the challenge is, right? Where are you going to find the equity to create these numbers of units? And that's where the rub is.
All right. Yeah. Thanks for your time, Brian. All right.
Thanks, Charlie. Take care.